Today we're talking about mortgage interest rates. It seems like we're talking about these all the time, but guess what? It is one of the biggest topics that is affecting our real estate market. So let's dive into it.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey, what's up guys? It's Sam Hartman. As always, we're keeping it real estate here in Fort Wayne, Indiana. And I want to bring some context and clarity today to what's happening with mortgage rates, how that's affecting our market, what's affecting the mortgage rates, and why it is so volatile right now in the current state of today's economy and today's market. So I want to start by looking at where we're at with interest rates today. We're going to look at the average here of the 30-year fix since June of last year. And you can kind of see at just first blush the volatility that's been happening with interest rates. We thought we were kind of out of the woods a few weeks ago where interest rates actually dipped into the 5% range, which was really huge and exciting. We saw a big comeback in mortgage applications at that time, which tells me that there's a great amount of buyer demand out there waiting for rates to temper. So if we do get that reprieve from rates again, expect that competition in the market to kind of bounce back as well. But that was a very short reprieve that we had on interest rates. It was maybe a day or two that they dropped into the 5% range. And now today we're back on the upswing at over 6.5%. The latest reading, this was a previous week, but the latest reading I saw was actually over 6.8%. And what's important to know about these 30-year fixed rate mortgages are that these are taking the average of the recorded mortgages. So this is taking into account buyers that are paying down their mortgage rate. So when you get your mortgage, you have the option to spend more money up front for acquiring the mortgage that's going to drop your interest rate lower. So this is taking into account not just where the upfront rate is, but it's taking into account those down rates for buyers as well. So keep in mind, if you go in to get a mortgage today and get a rate quote, it's very possible that that rate quote that takes into account no additional points or buy downs, it might be higher than this 6.5, 6.8% range. It's very, very realistic that it's going to be in the 7% range for you at this time. But that's where we are today. This is the general picture of mortgage rates. We came down, we got excited, buyers got excited, the demand bounced back in the market, and now here they are kind of back on the upswing. So why is this happening? What is going on in the world, in the market, that is creating this volatility in interest rates? And to help highlight that picture, I want to go to a quote. This quote is from Sam Cotter, a chief economist with Freddie Mac, and he says, "The economy is showing signs of resilience, mainly due to consumer spending, and rates are increasing. Overall housing costs are also increasing and therefore impacting inflation, which continues to persist." So we got to look at what the government's goal is today with their economic policy. And the government has not been shy about saying that they want to slow the economy down. They want to get inflation under control, back under 2% annually. And so as that is their goal, as they progress towards that goal, they're constantly looking at indicators like consumer spending. Is the consumer world still spending money, putting money out into the market, making transactions happen? Not just in housing, but across the board. Are people buying goods and services? And the last consumer spending report actually increased, which is telling the government consumers are still spending money, inflation is still high, and the indicators are showing that it's not slowing down. So a lot of consumers out there that are considering buying a house, they want the rates to come down, but it's not going to happen until the government gets indicators or sees signs that the economy itself is slowing down. They want to see less jobs in the market. They want to see lower incomes in the market. They want to see less consumer spending that is going to show them that inflation is starting to slow down and come under control. But guess what? If all those things start to happen, it's very possible that those things might affect buyers' ability to buy. If you lose your job, you can't buy a house. If your income decreases, that's going to affect your potential affordability. So really what we're looking at here is a constant cycle of good news and bad news. Good news if interest rates drop, but bad news because that means the overall health of the economy is deteriorating. It means we're looking more and more likely heading into a recession. Good news is if the economy stays vibrant, consumers retain spending money, the job market remains strong. The bad news is the interest rates are going to stay high. So we're constantly looking at a scenario where we're robbing from Peter to pay Paul. Here's a quick graph to look at over the last 50 years, how the 30-year fixed rate mortgage goes side to side with the 10-year Treasury yield. So when you hear about the government increasing rates and things like that, that's not necessarily directly tied to mortgage rates, but the 10-year Treasury yield does tend to react to that Fed funds rate, and the 30-year fixed mortgage then tends to react to the Treasury yield. So there is some cause and effect there. And so over the last 50 years, there's about an average spread of 1.72%, which is a difference from the 10-year Treasury yield to the current state of the 30-year fixed mortgage. So if the 10-year Treasury yield is at 4%, you might expect the 30-year fixed mortgage to be at 5.72. That's historically speaking. So this graph here paints a different picture. This shows how that spread has increased from 1.72% to recently 2.7%, and most recently now 2.93%. So that spread, that gap between the 10-year Treasury yield and the current mortgage rate is widening. So why is it widening? What is happening there? And basically, this is fear and uncertainty. This is banks and mortgage brokers not really knowing the direction that the government is going to take their policy, and they're building in additional rate fees for that risk and uncertainty that the lender is undertaking. So that is why this gap has really widened over recent history. So if we can get to a point where we're a little bit more stable with inflation, stable economically speaking, we get in a little bit more of a balance between that yin and that yang of what's constantly affecting our mortgage rates, we can see this gap close, which would absolutely be a positive effect on mortgage rates. That would just closing this gap from 2.93% to 1.72%, closing that gap alone would drop the interest rate by a full percent in the blink of an eye. So that could be another great positive indicator as the government work towards bringing inflation under control and bringing some balance there. That could also bring a positive effect to bringing interest rates down. But right now, as things stand with the volatility in interest rates, with interest rates being in the upper 6% and even looking at the low 7% here possibly in the near future, is really affecting buyer demand in the real estate market, because that is affecting overall housing affordability. For every 1% change in your interest rate, that affects your buying power by about 10%. So on a $300,000 house, if your mortgage interest rate is 1% higher, that's going to be $30,000 less house you're going to be able to afford on your mortgage. So that is really how it's affecting buyers in today's market and sellers in today's market. As these rates remain high, the buyer demand remains on the sideline. But here's some advice I want to give to buyers. As rates remain high right now, buyer demand is extremely low, which means competition is extremely low. So my advice to buyers out there is be extremely critical with your budget and your numbers, but be a buyer in today's market. Don't let the interest rate scare you. Buy the house that the numbers work for you and that you can afford. And then if and when those interest rates come back down, get refinanced your lower mortgage rate. Or even in today's current market with much lower buyer competition out there, you have more negotiating power as a buyer than we've ever had in a long, long time. I recently had a buyer negotiate a $10,000 seller credit to put towards a buy down program that is going to save them a ton of money over the first 2 years of their mortgage. And within that first 2 years, we fully hope and expect that they're going to be able to refinance that mortgage into a more favorable and more affordable interest rate. So a huge win for my buyer that they were only able to accomplish because guess what? The buyer demand is much lower right now. So let's wrap this up with one more quote from the Director of Real Estate Research with the National Association of Realtors. She says, mortgage rates increased further this week following the bond market trend. The average rate on a 30-year fixed mortgage rose to 6.5% from 6.32% the previous week. Even with the increase, owning a home is still affordable for Americans if they can put 20% down. The monthly mortgage payment is $1,888 for a median priced home. So you can see there, she's saying the affordability is being affected, but homes can still be affordable. She mentions putting 20% down on a home. And I want to stop for a second and highlight this for home buyers out there. You do not have to put 20% down on your mortgage to buy a house. It helps with the overall affordability picture of your standing mortgage payment. But if you don't have that 20% saved, you can buy a home with as little as 5% down. If you're a first-time home buyer, you can buy for as little as 3% down. And for veterans or people shopping in more rural communities, there are even loan programs that you can buy for as little as 0% down payment. So what's so important here is to take the time and the energy to educate yourself on what are your goals, where are you shopping, and what loan programs might be the most advantageous option for you to make homeownership affordable in this uncertain rate market. Here's the thing, there's going to be uncertainty no matter what the state of the real estate market. But I encourage you that information and education can bring a lot of clarity and confidence to making those decisions that you may need to make. So get going on gathering the information that you need. And I want to wrap all this up and highlight some advice for sellers in today's real estate market. Now, to be a seller, you're most likely also going to be a buyer in the real estate market. People tend not to sell their homes to then become homeless, unless for some unique situations they're moving maybe into assisted living or relocating across the country or even possibly moving into a rental. So for sellers in this current climate, you have an opportunity to buy with less competition, to be more flexible and have more choices in choosing the home that you move to. But when it comes to selling your home, we are going to need to put more time and energy up front into preparing your home so that it is in its best shape and putting its best foot forward for the buyer demand that is out there. There is still buyer demand, but buyers are becoming more and more selective with the homes that they are willing to buy because the interest rates are high and the prices are high. So buyer expectations have risen substantially over this last year because they don't want to buy a home at top dollar with top interest rate and then also have to pour money into making essential updates, fixing cosmetic fixes that are needing done, or fixing defects with the property. So sellers, take the time again to educate yourself on what your property needs to maximize the sale as well. Thanks for sticking with me today, guys, as we are continuing to be in many varying uncertain times in the real estate market. We're always going to be here trying to bring the best context, the best education, and hopefully bring some clarity to you and your real estate decisions so that you can be confident going forward in the real estate market. Remember, reach out if you ever have any questions or concerns. If you think this information could help someone that you know, make sure you like this video, share it with them. And if you have any questions that you want me to help answer on our next video, leave me a comment. Let me know. I would love to bring some answers directly to you that can help build your confidence in the real estate market.